Many people expect financial advisors to save their portfolio when the market goes down and go to cash. And successful investing typically doesn't involve anything to do with market timing. That's usually leads to just bad decisions and higher losses. One thing that a financial advisor should be good at, though, is protecting the client from themes that appear in investing. A long time ago during the financial crisis, I remember there was a theme in buying low volatility funds, which basically meant buying utilities, essentially. Eventually, so many people bought into the theme that the low volatility market became more volatile than the actual S&P 500 for a time. Thankfully, here at Wiser, we didn't participate in any of that. Something else that I'm proud of our team for doing is not participating in the ESG movement. That started during 2020 and kind of grew from there. Obviously, a big proponent of that was BlackRock, who has really backed off of their ESG push here recently. Understandably so, because ESG investing was supposed to mean higher returns because companies would be doing more ethical things with your money. And it turns out that those companies have to pay so much more to check all the ESG criteria to be included in someone's portfolio that they were actually not as profitable. It's just a company trying to make money. And that might make people happy who are big proponents of ESG, I guess. But I think most people just want to make sure they have a secure retirement and don't really care what they're invested in overall, especially in index world where, yeah, you might not agree with the company so much, but you know what? It's probably less than 1/5 of your total portfolio. And most people can tolerate it when they don't even see it on an asset list. The interesting thing about the whole ESG movement, which I think we can declare is over now because we're watching billions of dollars flow out of these funds, is all the financial advisors that sold these or promoted these to their clients thinking that they were doing good. And in the end, all they were really doing was just losing money. They were taking millions of dollars in extra fees, these ESG funds, versus what their counterpart would be doing, for instance, in the S&P 500. And so while some people will still push an ESG theme because they think that they're making the environment or social or governance issues better, they're really not. The only way to really do that is to vote your proxies for the companies that you do own, or simply don't own them, I guess, or get out and vote, maybe protest, write letters. That's how you make a difference. You're not making a difference buying an ESG fund. What you're doing is making that asset manager a lot richer by paying bigger fees. And financial advisors, when they're not getting fees from those funds directly, are helping aid that because they're telling the client what they want to hear and not the truth about what they're invested in, which I think as a fiduciary is our duty to always tell the clients the truth about what's happening and not to sugarcoat it or not to hope we don't lose a client because we don't want to tell them that the ESG is basically a scam. So kudos for our people for figuring that out. If you're just now watching this and you have ESG focused investments, I would encourage you to move back to the plain old vanilla index funds. The core, the S&P 500, the small cap, the international indexes. These are long-term healthy asset classes that despite ESG themes, you're never going to quite beat. Thanks for watching.